Right, we're going to start today by looking at the S&P 500. Um, you can see that we've been in a downtrend for the last month and a half. Um, the interesting thing about what's happening right now is we have we're going above the 20-day exponential moving average, and we have a catalyst for the stock market to go up, which is a truce in the war. So we have um, some of the good signs about the market is we have an upward sloping 200-day, 150-day moving averages, and our 20-day exponential moving average is starting to turn up. And you can see we're geared to start tomorrow 2.46% gap up day. Um, so basically, this seems like a end to this downtrend. And I thought it'd be very good exercise right now to go over some of the quality stocks um, that we've been following in the mutual fund top holdings and to see if there's any bargains out there after this correction. Let's look at the 10-year yield. You can see that we have an inverse correlation. As the 10-year yield goes up, the stock market goes down. And now that the yield of the 10-year is dropping like a rock, um, the stock market's going to be going up a lot. So what we have here is whenever the 10-year yield goes up, that's an indication of the inflation expectations along with the hot economy. And right now, with this supposed truce to the end of the war, which will have 2 weeks to work out a solution, and the Strait of Hormuz is going to be open for 2 weeks. This is a pretty big effect on equities, stocks, and bonds. So we're going to see a downward movement in bonds as the price of oil goes down. And what that also affects is the housing sector. I mean, there's going to be really good mortgage rates. We're going to have um, companies able to borrow money and grow faster, and that's going to help the stock market. So the price of oil has a lot to do with how the stock market does. So we had a shock here, and it looks like we're exiting that shock right now. Let's go to our talking points. Hold on for 1 second. Okay, you can see that I drew the lines in for the S&P 500 and I magnified where we're at. Basically, at the beginning of this week, um, we had some indications that the when the president gave his talk beginning of last week, we had some indications that he was trying to get out of um, the war and come up with a diplomatic solution. And that happened. You can see that we broke out of this downtrend um, and we're starting to go back up. So now we look at this 20-day exponential moving average on all of our charts. And a sign of a good time to buy a stock is whenever the chart goes above the 20-day exponential moving average, and then the 20-day exponential move average starts going up. So if we look at that on all of the charts that we're following, you see, we have a lot of the stocks that we're following in the indexes starting to go right above the 20-day exponential moving average. So let's look at our meeting notes. Okay, we're starting earnings season in the next couple of weeks. So that's going to help the stocks a lot. We do know now that this war is temporarily um, on hold. So we're on April. Okay, so we have 2 weeks now to work this diplomatic solution out. And if we don't, I guess the judgment day is going to be April 22nd. If we don't have a solution by then, the president will probably extend it. We've already extended our deadlines 3 times. So the president will probably extend it again with another excuse. So ultimately, I think what the president wants is to negotiate um, no nuclear weapons, etc. So we'll see what happens by the 22nd. But for now, we're going from oversold to overbought. We are overbought right now in the stock market, and we do have earnings coming up. We have tech earnings, we have um, we have bank earnings starting pretty soon, and we have the possibility of Fed rate cuts. As I was mentioning with this possibility of inflation with high oil, that reduced the possibility of rate cuts, and that reduced the possibility of stock market going up. But now we have lower interest rates um, that puts on the table rate cuts, and that helps the stock market. So let's look at some of our earnings that are happening. This past week, we've had Nike. There's not a whole lot going on. This is like the tail end of earnings season for the first quarter. So nothing market moving is happening both last week and this week. So this is like the leftovers from the first quarter. What's going to be happening in the coming, we're going to have bank earnings coming out. That's the start of the new second quarter earnings season. And then we're going to have the tech stocks, and that really moves the market. We have a big oversold um, tech in the tech field right now. And it's very natural for stocks. We've had very good earnings estimates for tech stocks and the S&P 500. So um, we have a rule where stocks go up with earnings estimates and earnings. So let's look at some of our talking points here. Hold on for a second. All right. So we have S&P up 6% from last week. So you can see last week we were right here at this bottom end. And right now we're up here. So it looks like we last Monday was a bottom for this intermediate time for the stock market. Um, and we have we don't have a whole lot of momentum in the market. Only 29 of percent of the S&P is above the 50-day and 42% above the 200-day. But we have a huge um, amount of relief in the market because we have a lot of unknowns that are becoming known now. So we are overbought in in our stochastics and in the S&P oscillator. But that doesn't mean that we can be more overbought. So we have the 10-year is actually down this week. This week we don't have momentum right now, but with this announcement of the end of the war temporarily, that is going to really help the market. Um, okay. So April has been traditionally a really good month. This is the best month of the year. And we have earnings coming out in April and May. So there's a really good reason for the stock market to go up because the earnings are coming up. You have to remember that the middle of the year, um, summertime people are on vacation. Traders, um, there isn't as much excitement in trading in the summertime. So we have a seasonality. Now that we're starting to have a good vibe in the market, we're getting back to our seasonality and stochastics. And August, September are traditionally bad months, so you got to be ready for that. And June has traditionally been a bad month too. Um, all right. Okay, so the S&P short range oscillator is overbought right now at 2.29. After tomorrow, when the market gaps up, it's going to be a lot more than that. So the overbought signal is suggests the market is overextended. And so it's probably going to be extended for a while while the people are excited about the end of this war temporarily. Let's look at the reversal of our situation in the war and how it affects us. Okay, before we had our formula for a war was price of oil increases, inflation increases. Now we have the opposite effect. Formula for the current situation, price of oil decreases, inflation decreases, the chance of rate cuts go up now. And stock markets like rate cuts and recession chances go down. And so we're switching right now from a downtrend to a possible uptrend in the market. So this is our modified Guppy trend. After this week, we're going to have it starting to go up. And let's look at we already looked at that. Let's look at the price of oil. It's gone down 4% overnight. Um, Actually, it went down 16%. So last week it was 101. It was like yesterday up to 106, 116. But there's a good chance that the Strait of Hormuz is now open for at least 2 weeks for during the truce. And so high oil is inflationary. Now that we have a lower price of oil, the inflation most likely is going to go down with it. So the US dollar index is going down. It's down 2%. And our formula is commodity prices are priced in dollars as the price in dollars as the DXY goes down, the dollar index, the price of commodities go up. So we actually have a one-to-one correlation this week. The price of oil, the price of gold went up 2%. So um, we were looking at gold last week on the chart as a potential. Um, it's actually momentum play. And let's look at the chart of oil right now. I mean gold right now. QQQ gold. You can see that we've been in an uptrend for multiple years for this gold trade. Um, gold has traditionally been risk off because in bad times you would normally have people gravitating towards gold, which is a consistent hedge in inflation, and over time it's been a consistent good performer in bad times. But we had a sell-off in gold, um, maybe due to supply and demand. But we have a situation now where the US dollar is going down in DXY. So we also have um, a momentum phase in the market where everything that used to be risk off for the last couple of weeks is now risk on. So it looks like this gold is going to go back into this trading range in that lower highs, higher highs and higher lows. We'll watch that. And okay, in the US dollar, you can see in the past 2 weeks, we've been going down. So we'll keep our eyes on that. That helps the multinational companies like Facebook, Google, and the big tech stocks. Remember, the big tech stocks took a big hit recently. A lot of them are down 20, 30%. Let's look at the fear and greed index. We can see that we still have extreme fear. Um, our translation is time to hold your nose and buy or don't sell. So last week we had a 10 extreme fear, which is as most extreme as you can get almost. So the individual investor is bearish. They've been bearish for the last 8 weeks. So the translation is you have to do opposite what the amateur investor is doing. It's time to start looking for something to buy or don't sell. All right, so let's look at the VIX. The VIX is up to 26 as of today. Um, that is a fear gauge, and you can see that we were up much higher. We were above 30. 26 is pretty high, but on a good day, when we gap up 6%, no, 3%, like tomorrow, um, we're going to have this fear gauge going down. So the important thing to keep in mind is whenever you have a fear of 30 or above 30, 30, 50 or so, that is a panic. That is when Warren Buffett says to bring out the bucket, not the thimble, because whenever people are panicking, it's usually the good time for you to buy. All right, so right now we're still in a fear phase in general, but that could totally swap to enthusiasm with a possibility of an end to the war and the problems in the Middle East going away. Um, then we're left with an AI stock bubble problem. We have the possibility of AI spending, and maybe AI isn't going to pan out. All these companies are spending money. Are they going to get a return on their investment? So it'll turn from worrying about the war to problems with the United States debt. Um, what other problems do we have? Tariffs. Um, we have a crisis with um, private credit. So a lot of the banks still face the possibility of a mini crisis with private credit. So even though tomorrow we're going to gap up and all the stocks will be going up, all the worst stocks that have went down the most will be going up the most. We still have to have in the back of our mind might have a banking crisis um, in the horizon. A lot of smaller banks that lent to private private credit, it might go under. We'll see. But if you stick with the big companies, that's why whenever we're doing our stock research, we focus on the large cap companies because they won't get most likely in trouble with situations like private credit. All right, so let's look at our worst to worst. Okay, so now you can see energy is up 34%. This was the worst performing of last year. And now the IT is one of the worst. So now we have consumer discretionary. This could all flip around, if we end the war and we don't have to worry about that anymore. Um, but we have to keep in mind that we still have an AI cycle in the market. So tech stocks, utilities, are going to benefit from that. We have for financials, they are the most undervalued. If we look at our S&P sector valuations compared to history, look at financials right now. They are for a 10-year, their percentile is down at 31, which means they are super undervalued compared to history. So if you're not invested in financials, it might be a good time to start looking at some of the stocks in that sector. Because even though we might have a mini crisis in finance, some of the financials like Visa and MasterCard, they are immune from the private credit cycle. They basically are toll collectors, but they're lumped in with the financial group because if they all go down together. So for me, in times like this, I look at a company like MasterCard. Let's look at it just for fun right now. MasterCard is growing about 20%. The interesting thing about this time with MasterCard, look at this. This is the tariffs announcement. We are right exactly at the bottom where we were at that tariffs announcement. So this is a example of a double bottom. This stock is, I don't see anything wrong with this stock. Let's look at the numbers on this just for fun. We're gonna look at the growth rate. Okay, we're gonna do this. We're gonna do this calculation real quick because I remember I'm excited about this stock. Special. Okay, so MasterCard right now, this is their earnings estimates we just got from that web page. You can see that they're growing 16% a year. And if we look at their, okay, their 4P is 25 right now. So their PEG ratio, they're like 50% overvalued right now, but you pay more for a card that starts every day. You can see that their profitability is like out of this world. Their return on equity is 200. This is like 7 times what we're looking for. This is an example of a financial stock that got thrown out with the bathwater. Um, so this is in my long-term portfolio, and I'll never sell this one. And this is the perfect time to start dollar costing into that one if you don't have any financial um, in your financials in your portfolio. Let's look at, okay, so what other sectors are down so far this year? We have IT. So this is a good time to start looking at IT. It's down 6% this year. Um, S&P is down like 3% this year. But I'm going to look at a lot of tech stocks that are down and have a good chance of rebounding. Let's look at, okay, this is, I like to review this every now and then. 125 years of market history tell a simple story. Stocks and earnings move together with a 98% correlation. Short run is about noise. The long run is about profits. Speculators chase noise. Investors follow profits. So what we know from this year, at the beginning of the year, S&P earnings estimates were estimated to go up 14% from the beginning of the year. And now towards the middle of the year, they're up 17%. So that means there's a very good chance the S&P is going to go up 17% this year. So right now we're down we're down like 3%. Let's look at what the S&P 500 year to date is down 3%. So what they're saying is if the earnings grow at 17%, that means you probably make 20% if you invest in the S&P right now. This is another reminder that if you have your money in cash, let's say you had $1 million and you didn't invest it, um, if you held your money 20 years, then you would have lost your buying 50% of your buying power. And this is because of inflation. Um, so if you had $1 million 20 years ago, right now it would be worth like a half a million in buying power. So that's why it's important to be invested and to stay invested. So let's look at some of the stocks going up and down. Okay, we do know that the interest rates have been going down. So let's look at, okay, okay, okay. As the interest rates, you can see we started this downtrend. As the oil prices are going to go lower, the interest rates on the 10-year will go lower also. So we have a translation, yields of the 10-year going down. When a 10-year Treasury yield falls, it generally signals lower interest rates, which benefits sectors with high debt, high growth potential, or dividend-paying appeal. So the stocks that will benefit the most will be tech stocks, small cap stocks, high yielding stocks because with lower yields on a 10-year guaranteed investment, people will be reaching for equities that pay dividends. Home builders, right now, they are down and out, but right now, that is a huge catalyst for them to start going up. Okay, so let's see which sectors are going up and down. Okay, you can see iShares home construction down in any kind of home related stocks. We expected them to be going up. Well, mm, yeah, we expected home construction, home builders to be doing better with a lower interest rate environment. Maybe this will turn around tomorrow. Um, Retail, metals and mining, biotech ETF. Hmm. Okay, we expected biotechs to do better because they borrow a lot of money and they're very heavily indebted. They're not really profitable yet, so you think that lower interest rates would help them. Um, okay, right now oil services stocks are going up a lot. So this tomorrow, this is going to switch around. Oil services are going to be going down 10%. Telecom, this makes sense as the 10-year yield goes down, the demand for high yielding investments go up. Gold miners, as the price of the US dollar index goes down, the price of gold goes up, and the gold miners will go up with that. And we have semiconductors. They benefit because they can grow faster in a lower interest environment. Energy, um, that's up with the price of oil. Energy select and okay, that was a good little exercise. Utilities pay a high dividend, and healthcare sector pays a high dividend. So those would be more demand as interest rates go down. Now, when we have a risk-on rally like we will tomorrow morning, um, we're going to have everything that's high risk, and we're going to have the stocks, everything that benefits from a lower interest rate to rally. Let's look at the stocks going up and down the most. We have United Health. We had some of the insurers go up a lot because of a favorable announcement from the government that they're paying more for healthcare benefits. And so all the healthcare related stocks go up together with that news. Broadcom had a huge announcement from Google. Broadcom basically said they are going to get a big order from a lot of major companies like Google and other companies for um, cheap their custom chip manufacturing. CrowdStrike has gone up a lot. They've gone down a lot. So um, I don't know the news for CrowdStrike though. A lot of these stocks have been taken to the woodshed. A lot of the CrowdStrike, a lot of the software related stocks. The interesting thing about CrowdStrike, we mentioned this a couple weeks ago, they are number one in their industry. So um, and they're not affected by the AI. It's very hard by the AI revolution because it's very hard to replicate what they're doing. Palo Alto is very similar. Intel is up because they're making a deal with um, Elon Musk's new chip venture. And you see, let's look at the ones doing the worst. We see the theme here is risk off. These are stocks that um, are safe stocks. It seems like what's happening right now in the stock market, we're shifting from risk off to risk on. So a lot of the stocks that were safe stocks in general that did well during the downturn, they're basically people are exiting those and going more towards risk on. So let's look at our risk on, risk off stocks. When we had the war with Iraq started, we had basically two categories, and they would go in a diametric um, directions. We have risk on, which are IT, financials, industrial, consumer discretionary stocks with high PE ratios that have been the best winners in for the past couple of years. And risk off is energy, consumer staples, very conservative. So what we have right now and what we're going to have tomorrow is the tale of two cities, risk on and risk off. And usually they don't go up together or down together. They're just right now we have risk on in the stock market, and everything um, related to that is going to be going up. So this is going to be swapping. This is going to be very similar tomorrow. All right, so that was good exercise. Let's go back to our talking points. Okay, let's look at Dan Now's picks from the beginning of the year. This PI impinge is like really doing really bad. It's down 41% this year. Nike, they had a really bad earnings report recently, and they're down 33% already from a um, low price. So let's look at Nike, just because I like to look at stocks that just as a lesson learned, NKE. I'm going to look at two stocks, Nike. You can see the PEG ratio for Nike is 1. That is an indication that they bottomed out. Usually high quality stocks, this is like a turnaround story, but you can see from last year and this year, their earnings estimate went down, but they're expected to grow. So let's look at their numbers again. If we put it into my east. Okay. So they're expected they were their earnings, hold on. The earnings were down 25 to 26, 18%. One of their biggest mistakes was Nike took their sales out of the Foot Lockers and they made it online. And so what happened was they invited all their competition, such as um, to take their space and they lost a lot of business that way. So they're still recovering from that. They're back in the stores like Foot Locker, but still, so they're down 18% from last year to this year. And they're expected to grow 41%, and then they're back to zero growth again. So that's not that exciting for me. For me, I like to see 10%, 10%, 10% or better on a regular basis. So this inconsistency makes it very hard for me to even look at. Um, okay, so it's seemingly, at a good peg ratio, but it's not consistent enough for me to make a purchase. Okay, so where are we in our talk? Um, okay, so we have a new I asked Google AI, what is the current stock market narrative? The current narrative is defined by extreme volatility driven by high stakes geopolitical tension. So we have geopolitical conflicts are the key drivers, AI and sector rotation, and investors are pivoting towards AI related stocks. However, some mega cap stocks like Tesla are facing pressures, and Microsoft is also another big one facing pressures. Macro and economics, despite risks, U.S. consumer spending and manufacturing remain robust, supporting a resilient economy. Upcoming focus, key catalysts ahead. We have an inflation reading and earnings are going to come out. So I've updated this game plan. We have the good idea right now is the dollar cost, meaning buy a little at a time into high growth stocks that are in the top 10 of mutual funds and ones we track, ones that are growing 10% or more consistently. Look for companies with high free cash flow, low debt, and growing 10% or more. Buy small amounts of quality companies as they sell off. Now, we have a rally tomorrow, a gap up of 3%, but that doesn't mean that it's all clear. We still have a possible bank crisis. We have 2 weeks. We might have another crisis where we have that deadline of 2 weeks, which we might extend. I don't know. So that's why it's important to dollar cost into the things you're looking to buy. Um, Look for stocks selling at a low peg ratio, safe from disruption, and rotate into undervalued sectors relative to history. Financials are an example of a sector right now totally out of favor. Um, you never know when the bottom is, but I bought JP Morgan during um, the COVID crisis in 2020. So whenever you had, and no one knew what was happening, I knew it was the best bank. So this is an example of when you start buying a little bit of quality stocks like MasterCard that are doing a double bottom and are down with sectors like the finance. Okay, so just keep in mind this this chart here, relative PE valuations relative to history. And you can see IT isn't the most expensive sector anymore. It's like the percentile is 43. It used to be 90 at the beginning of this year. So it's becoming partially an undervalued stock sector. Okay, so we had some very interesting YouTube. You might want to click on this article, these links and watch it. Ed Yardini says the market bottom is in, even though we have this 2 week um, temporary truce. He says it all makes sense. It's just like the tariff tantrum of last year. We have an out. We have the markets needed an exit ramp, and we got one with this truce. We have postponed obliteration day, and that's good for the market. Tech has gotten cheap, he says. PE of tech went from 32 to 22 for the tech companies on average. So that is so tech stocks in general, they grow between 15 and 20% per year. And that is the highest sector, but they're most volatile. Here's another article on YouTube that says the risk reward is quite good for stocks now, says Fund Strats Tom Lee. He's like a perennial bull. He'll always say that the stock market's going up. But he made some pretty good comments about um, the effect of war on the economy. And usually we have good prices in the stock market after a war. And he thinks 90% of the weaknesses are behind us. And another story, Dan Niles, we follow him. He says chip stocks will get stronger as the year progresses. So we have a lot of confidence in the analysts. And we do have analysts that say the S&P earnings are going to be up 17% this year. So all in all, it seems like we have a possibility of going up 20% from here. Um, okay, so when we started the war, we had this formula: price of oil goes up, inflation will happen, and consumers will have less to spend. Now all this is like kind of switching around, um, and we're going from risk off, where we have energy, consumer staples, utilities being in in demand. Now we're going to have financials, industrials, consumer discretionary, and tech stocks for the most part are going to go up. So we'll keep that in mind. Let's look at some interesting charts. Rats, hold on. Okay, this is the first interesting chart. We have Alphabet. You can see that Alphabet has regained its 20-day exponential moving average, this yellow line right here. You can see that it's starting to turn back up. This is like a good turning point in a stock whenever it goes from under all the moving average to reclaiming this 20-day exponential moving average. And then when it gets above all of the moving averages again, then watch out because then it has momentum. Let's look at yeah, the interesting thing about Alphabet, it owns 7.5% of SpaceX, and SpaceX is going to IPO in June. So keep that in mind. That's worth at least 150 or 200 billion. And on top of that, SpaceX is going to double the first day. So you know that that's going to double the 200 billion investment to 400 billion. So they're going to be a primary beneficiary of that. Let's look at the 2-year chart of um, this is Alphabet. You can see that we had that same exact downtrend last year during the crisis. And we look at this chart compared to this chart. It's almost the same. Now, look at the yellow line here. We'll zoom in just a little bit. Rats. I shouldn't have done that. Okay, look at the yellow line. That's a 20-day exponential moving average. Whenever it started to turn positive and its stock went above that, this is the perfect time to start accumulating Google. And then whenever that 20-day exponential move starts going up, and right here, this is when the stock goes above all the moving averages, it's off to the races. So right now we've just across the 20-day exponential moving average. So and it's starting the 20 days starting to move up. And that's happening with a lot of stocks. So whenever we're going over our charts, we're going to be looking for that combination. Okay, so let's look at our next stock, Micron. You can see that we are still in an uptrend. Look at this. It's almost a perfect uptrend. It bottomed right at the bottom of our channel, and it's probably going to go up to here next. And here and here. So we're going to go over the financials on Micron again because that's my favorite stock right now. Google and Micron are my favorites. Let's look at Microsoft. This has been um, thrown out with the bathwater with the software stocks. We're going to go over the financials on this one next too, but you can see, just like MasterCard, we're doing a double bottom. This is the same exact price Microsoft was during Liberation Day last year. Whenever you have a double bottom, that's a very good indication that you have support there and that you would have a good chance of bouncing. And we're oversold in our stochastics. So let's look at, and we're approaching our 20-day exponential moving average. So everything's lining up for Microsoft also. Now, I mentioned MasterCard, how we're in a downtrend right now with all the financials, but look at this. We're at the same place we were last year during Liberation Day. And that's a very good indication we have support at this level right here. And we're starting to go above that 20-day exponential moving average too. So we're keeping our eye on that level right there. And let's look at NVIDIA. NVIDIA, look at this. For a stock that's growing 50% a year, it's in a trading range. And you can see every time it gets down to this bottom part of the trading range, it's a good time to buy. And it'll probably go up to here next. And until we have earnings, it'll probably stay in this pattern. So we'll keep our eye on that pattern. Give me some news stories. Bill Ackman says um, it's one of the best times to buy in a long time to buy quality stocks. We mentioned this last week, and some of the highest quality businesses in the world are trading at extremely cheap prices. We're going to look at some of his top picks because we didn't do that last week. So we're going to look at that, and because right now a lot of them are down big time. Let's look at his top holdings. His top holdings are, look at this right here, BN. That's an energy company. We have Uber. That's a kind of a speculative company. It's not a big company. I'm surprised it's in his second biggest holding. Actually, Google or Alphabet is his top holding right now. If you look at, it's 12% of the portfolio, and then the other type of Google, the other symbol is 8%. So if 8% plus 10%, that's 18%. That's near the top three. So, but I highlighted Meta and Amazon. He increased this number of shares of Amazon and Meta in this past quarter. So he thinks it's time to buy stocks. Let's look at Meta, Google, and see if they're still quality. Okay, this is just a reminder. When the time is come, when the time comes to buy, you won't want to. And we mentioned this last week when everything was going down. It's important to dollar cost whenever stocks are going down if you're not invested. Dollar cost means buying a little at a time. Um, we also have this story from Larry Fink that warns against market timing. We mentioned this last week that missing the best days can have returns. So it's important to be fully invested in good times and in bad. And if you have new money coming in, you don't want to put it all in at once. You want to dollar cost into the market. So I like to keep that in the back of your mind. Um, okay, so if you miss the top market days, I think tomorrow might be a good market day. Um, if you're fully invested, you have high consistent returns. Miss the 10 best days, returns are roughly cut in half. Miss the best 30 days, your returns will be reduced by 80%. And missing only 10 to 20 days over 20 years can cause a portfolio to underperform compared to simple holding. Okay, so the best cluster, the best days cluster with the worst days. So as we can see in our stochastic charts, you can see the worst days of this year could be paired with the best days of this year. So you don't want to be absent during the best days of the year. All right, so let's look at some of our stock screen for this week. I've been highlighting Micron for like the past 20 weeks, and it continues to have like an amazing valuation. Everything across the board, they have a great earnings estimates forward. They have a PEG ratio of 0.1, and they don't get any respect. We'll go over Micron's um, numbers again later. Um, GE Vernova is one that sticks out as a 0.75 PEG ratio. We'll look at that. They make the turbines for gas-powered AI data centers. Um, Look at Marvell. Marvell is like 10% off. It's not that much, but they make custom chips also. Um, okay, we also see a lot of financials in this screen. So we have a lot of financials on sale. Um, we have JP Morgan, we have Bank of America, we have Morgan Stanley, Goldman Sachs. So these are Wells Fargo. These stocks are like the babies thrown out with the bathwater. Right now, that is a good sector to look into. This is Warren Buffett's one of his top holdings, American Express, Citigroup. Um, no one wants financials now, but this could be a good time to start dollar costing into that sector. Let's look at GE Vernova. They make the gas turbines for AI data centers. Um, they have a PE ratio of 61, which is usually really high. But they're growing. If you look at their growth rate, they're growing at 55%. So they're just about fairly valued. I mean, this is a high growth stock. And if you look at their chart, let's look at their chart because I think that's very insightful. I didn't actually when I'm if you look at their chart, they are one of the best performing stocks in the stock market. In a down market, the S&P's down 5% this year. They are up quite a bit and they're in an uptrend. And you can see that if I drew lines at the bottom and top, they are definitely within a channel. Um, and they're on a roll. So um, that's a good one to look at if you're not invested in that. It's a very good way to diversify because it's not really a tech stock and it's growing a lot. And look at these numbers. These are pretty good. Profit margin's 12. Return on equity is 42. That's double we're looking for. And they have like 7 or 8 billion in debt. No, 8 billion in cash. So they're very profitable and they're growing like 50%, 55%. Let's look at Micron again. I hate that they keep bringing this up, but it just seems like it's such a great deal. I don't know why people are selling it. Right now, its PE ratio, forward PE, is 6. Can you believe that? And their PEG ratio is 0.21. Um, so their growth from this year to next year is 11.7, but 27 to 28, it's 334. So if we took the 334 as the growth rate divided by 6, that's 53 times undervalued. If we use this year to next year, it's 2 times undervalued. So it's growing at 12% and its PE ratio is 3. So it'd be half off to be super conservative. Um, but look at these numbers. Profit margin is out of this world. That's 3 times what we're looking for. And return on equity is 3 times what we're looking for. So this is the best quality stock that I can find. If it goes down, um, I will definitely double up on it. All right. So this one is Meta. This is one of Bill Ackman's recent purchases, you can see that it's growing from last year to this year, it was 30%. And then consistently they're growing at 16%. And this stock is in the top holdings of a lot of mutual funds. Um, right now they're just about fair value according to Yahoo. And they don't go on sale very often. Their profit margin is three times what we're looking for, and so is their return on equity. So, and they have 80 billion in cash. And wait, they have 80 billion in cash. They have around 4 billion in debt, which is not a lot for a 1.45 trillion dollar company. So, I think this is a super high quality stock. If you're looking for a stock that you can buy and hold, and they're going to grow, they're very innovative, and they are implementing AI, and they're at the cutting edge. So, this is a good stock to buy if you haven't invested in stocks in the tech sector yet. Let's look at the Fidelity Contra Fund top holdings. Meta is 11% of that's the top holding. NVIDIA is 9%, Amazon 5%, Berkshire Hathaway 5%, Google 4%, Microsoft, actually Google is 7%, and we have Amphenol, Apple, and Eli Lilly. So it's really good to keep in mind they haven't changed a lot of their top holdings in like 15 or 20 years. If any of these stocks go on sale, like Meta, NVIDIA, it's a good it's a good idea to start buying some if you're interested in having a high growth portfolio for buying and holding. Let's look at NVIDIA's numbers. From last year to this year, they were growing at 73%. And you can see we have decelerating earnings. Basically, their earnings are cut in half every year according to estimates. But they're still growing from this year to next year at 32%. And their PE ratio right now is 21. So that means they're 35% undervalued. Their PEG ratio is 0.65. Um, but look at these numbers. Profit margin 55, return on equity 101, and they have 40 billion in cash. And they're aggressively buying parts of companies too. So they have um, parts of some of these AI companies. They invest in some of the AI data center stocks. So they have a lot of things, investments that are going to be coming um, public pretty soon. So that's not really in the numbers here. Um, Microsoft. This is stock we were mentioning last week or the week before. You can see they're growing 18%. Their forward PE is 19. It's not every day that Microsoft has a fair value of around PEG ratio of 1. So this is a good quality company that's going to continually grow. They're diversified in what they sell. They're not just AI, they're just not computers, Microsoft Windows. They sell games, they sell cybersecurity. They are very diversified. Um, let me see. Let's look at Eli Lilly. It's another one of the top holdings of Fidelity Contra Fund. You can see it's growing at 23% this year. So if they're growing at 24%, the P/E ratio is 27. The PEG ratio is 1.1. So they're just about fairly valued right now. And they have um, a good catalyst. They have a weight loss pill that just was approved. So that's going to give them a new product, and they can manufacture that much cheaper than anyone else. And they're injectables. So they're going to make a much better profit on the pill. Also, there's a lot of people that don't like taking jabs in their arm. And for those people, this is going to be much easier um, to take. Also, there are competitors that sell weight loss pills. They make you take it on an empty stomach. There's all these rules, and there are no rules for this weight loss pill. So they're light years ahead of their competition, I think. So this is one of my favorite drug stocks. Um, here's a story. Google and Microsoft hidden assets and market navigating. This case, if you watch this YouTube video, you'll find this guy talks about how Google has this other bets part of their business, like Waymo. They um, they own 7.5% of SpaceX. They own 14% of Anthropic. These companies are going to go public pretty soon. And just their SpaceX is going to double and whenever it IPOs. And so is Anthropic because they have um, SpaceX has some products that no one else can replicate, and they're growing really fast. So that's that's interesting. Microsoft has investments in OpenAI and a lot of the of other companies. One problem is they need Copilot investments to pay off. They're investing a lot in AI, but they haven't really got a return yet. So they're growing their cloud business a lot, and that's kind of how they get their return right now. But if they can get Copilot um, subscribers, that would really help that stock. But I've held Microsoft since like 2008. It's been like one of the best parts of my portfolio. Um, Google, I've owned that since 2008. It is growing at 16%. The P ratio is 25, so like 1.5 P PEG ratio. So that's around 50% overvalued. Um, you can see that they're very profitable. Their profit margin is 32. That's three times what we're looking for. And same thing with return on equity. It's 34. That is a really good um, return on equity. So they're and they also have catalysts where they have all these other bets, and they're all starting to pay off now. All right, so that was my talk for today. I hope you enjoyed it, and I'll see you next time.